Not a topic, but if I wanted to have a potential, um, someone who can potentially come in and discuss the club, we reach out through Daniel. Is there anything that he requires them to do if I wanted to bring someone in?
For a speaker?
Yeah, for a speaker.
He sends out a list of like what to put in their talk and what not to cover. So I can send that to you, William.
Okay, thank you.
But as long as it's an interesting topic, I don't see why he would not have them want to come in.
Okay.
All right. Any other questions? So a disclaimer, this is definitely the first time. I have a couple of them throughout the presentation. I'm gonna go ahead and get started. So this is my experience, and I didn't really realize what the topic was going to be until Daniel sent me the slides. So I want you guys to ask as many questions as you want. This is definitely my experience. So this is a recap of my journey with tax deferred accounts. And I obviously am not a financial or tax advisor. And I tend to operate in some of the gray areas, as those who know me will testify, because they'll always ask me, hey, are you allowed to do that? I'm like, well, I did, but that's just me. So feel free to, question me on why I do stuff. The other thing is when I do stuff, I want to find out all the information. For instance, like when I knew I was going to start investing in real estate, I wanted to learn about taxes. So I took like a tax class from Jackson Hewlett. I spent a couple of years doing people's taxes because I really wanted to understand the the situations with regards to real estate. So, I wanted to make sure I could answer my own questions. From me buying something and trying to sell it after I rent it, after I turned a primary into a rental, and it was a loss, and I wanted to make sure I could write off my loss. And my first tax person said, no, you can't. But I knew in my heart that I could. So that's why it inspired me to learn on my own. And I realized that I could. So when I did my admitted tax return, I was able to get all that money back. So that was kind of cool. All right. So just, you guys, I'm sure you guys probably know some of the stuff already, but if I look at like where tax, when you think about taxes, which accounts do they come from? There's three big buckets, probably, everybody knows. There's a taxable bucket, this could be stocks, bonds, whatever, mutual funds. You pay capital gains tax. There's a lot of things that fall into the taxable bucket. My list is not exhaustive, so there's a lot of things that go there. There's a tax deferred bucket, which you can have all kind of things in there from stocks and bonds and mutual funds. But this is when you pay the tax when you withdraw the money. And then there's the tax-free bucket. So that is my goal for getting to, because when you don't pay taxes, that's always good. The kind of stuff that goes into the tax-free bucket are going to be things like your Roth, which is either 401k or your IRA. You can have both of them as a Roth. Your HSA, health savings account, your TF, your tax-free retirement account. That's done through an insurance company. They also have their little vehicles. Everybody has different names for them. So the whole goal is you pay no tax. And a question that gets asked of me a lot is, how much money should I put into a specific account? So I always tell people to max out the pre-tax to the match and then go Roth. So I'm going to make this interactive, and I'm going to ask you guys going forward, and you guys can put this in the chat. Do you think income taxes are going to increase, decrease, or stay the same? So in the chat, put either increase, decrease, or same. And then Ami, you can tell me which one we get the most of.
Increase unanimously so far.
Okay.
One person has said depends upon who wins the re-election.
Okay, perfect. So I'm gonna take a little side trip. I'm gonna build the strong case for why taxes are going to increase. Okay. So if you look at, and I just did, this is very, very just arbitrary. I said, you know what? Let me pull the 10-year running average of our debt and compare that to the GDP, which is the gross domestic product, and look at the ratio, because that's really this ratio basically gives insight on whether number one, we can cover debt. And this is important because if you're an investor, there's a threshold that you kind of look at, that's the tipping point, and that's like 77%. So that's always kind of cool when you think about what does the World Bank think about when it thinks about tipping over, the debt ceiling or whatever, all those conversations. If you look at, I was going to take 2003, but it's not out for the year yet. But you look at from 2002 to 2012, you see the increase there. And then starting even at 1992, our ratio is 61%. It kind of went down and it goes up and down a lot. But then we get to 2012, it was 99%, which was way over the 77 threshold. And now it's like 123. That's crazy to me. So if I look at it from 2012 to 2022, that's astronomical. All right. So the other thing I'm going to ask you guys, this is kind of a pop quiz. Do you think, and I kind of gave you the answer. So if you look at how much the Fed fund rate was in 2012, the Fed fund rate is how much you have to pay to borrow money. And then if you come to 2022, which is like 4% on average, do you think the cost to borrow money doubled, tripled, or quadrupled? You can put that in the chat.
But for whose cost to borrow money?
For the Fed to borrow money for the economy. Like, how much do you think our cost would have been to pay back our debt money?
The country?
Yeah, the country's debt money. Like I'll just say our payments. The payments that we have to take to pay off our debt, do you think they doubled, tripled, or quadrupled from 2012 to 2000?
We are getting different answers on this one. We have doubled, more than doubled. We have a couple that say quad, one that says triple.
Okay, so actually it's more almost close to quadruple, because we definitely doubled our debt, which costs, which is like doubling. And then the cost to do it has also doubled. So actually it's quadrupled. So that's why we're in trouble. That is why we're probably going to be raising interest rates. So that's just a little exercise. So getting back to going forward. So if we know that interest rates are going to go up, it's good to be in that tax-free zone. So for me, in my mind, I was thinking, how do I maximize my income? How do I minimize my expenses? So the strategies that I took was, I need to make sure everything's deductible. Number one, if I buy something for my primary house, I'm gonna write it off on my secondary house because I need it to be deductible. I took a couple side hustles, and then I also learned to invest better. I know when I first started Intel, when I was working there, I filled out my W-4 and I just sat it and forgot it. But then I went back and I was like, wait, I don't need to be giving all that money to the government. That's money I need to be investing. So that's, I needed to take another look at that. And as far as minimizing expenses, I mapped everything to my rentals. True story, I wanted to go out and buy a 911 because I love 911s. So in 2097, I went on about 2-year-old 911. I leased it, which is another story in itself. The payments were $800 a month. And I said, you know what? Because I went to not real estate school, I did that too, but I went to tax school. I said, I'm gonna be able to write off these lease payments because I have 2 vehicles. I'm using 1 vehicle to use to check on my rentals. So that's what I ended up doing. Perfectly legal. And going back, I work in gray areas. So that was kind of fun. What else? And then just stop buying dumb stuff. That's the only tip I'll give you. Okay, any questions on this one slide? This is kind of an intro slide to me. Okay, if not, we're gonna go on. So my top 5 tax deferred methods. Some of these y'all might practice, already know about, but this is just my
Excuse me.
experience.
On the
For
last
what?
slide, can you please elaborate on what TFRA is?
TFRA from the other slide,
Yes.
it's tax-free retirement account. Those are accounts that you can have through an insurance investment tool.
Like an annuity.
Yeah, or like an annuity or something like that.
Okay, thank you.
You're welcome. Any other questions? Okay, so my top 5 tax deferred methods. Mega backdoor. So if you're working, you got to be working for this. You pretty much put money into your 401k. And I think the limits are probably 22.5 if you're not over 55 and 30,000 if you're over 50. But actually the limits are really 66,000 and 73.5 thousand. So I'll talk about that one in a minute. This one, sometimes you call Fidelity and you ask them about it, and some people don't know, so you got to ask for a specialist. I learned that going through. A charitable gift contribution or account. I love this because I donate or contribute to a lot of nonprofits and schools and churches and things like that. So I set up that account because I was able to like take some stocks at the end of the year and move them over to that account, get the write-off for those stocks that I gave, and then I control where the money goes. And every time money goes there, I usually claim that, even though I probably shouldn't, every year as I give that. So that was pretty helpful. 1031 real estate exchange. This is just a way to defer capital gains. I think we talked about that before. So I'll go through an example there. And then the 4th one is the Roth Conversion using a syndication opportunity. So this allows you to reduce your taxes because of Roth conversion taxes. So I'll go through that in detail in a minute. So, and then the last one, conservation easement, which I'm probably not going to go through in detail because there's a lot of information on the web, but this is more of a tax deduction strategy. And a conservation easement is pretty much a legal agreement that a person makes, that a person who owns land makes, and they do it voluntarily. And the agreement is between the landowner and either the trust organization or a government agency. And it's so they can conserve a piece of land. And in exchange, they get a deduction to write off on their taxes. And sometimes that deduction could be 3 to 5 times the multiple. So if you say you have this land for 50,000, you're going to convert it into a conservation parcel, then you might get 250,000 to be able to write off on your taxes. So that one's, I know a lot of people use that. I don't typically like it because sometimes I feel like there's a lot of loopholes and there's a lot of cons, but that's one thing that I thought about using last year. Okay, so let's go through each one. Mega backdoor. This is cool because it allows you 6 times your normal IRA contribution rate. So if you just wanted a contribution to an IRA outside of it, you get $6,500, right? That's crazy. But if you're working, you can basically increase that amount. Now, for me, I used to think, where would I get all that extra money to put into this Back Door Roth? And I think what the lady helped me realize is if you have other money coming in from like a rental property or something like that, and a lot of times people put that money into a bank and they don't think about it, use that money to live off and then just, bank your paycheck. So that's what I did there. And then, it goes through all the steps about what it is. It's mega because it's a lot, how much you can contribute. So it's 43,500 minus what your match is. So like if you're working at Intel, you get $8,000 or $8,500, then you'd be eligible to put an additional 35,000 into this Back Door Roth. So I think that's kind of cool. And again, it's great. Who is it suitable for? This is great for those who are currently maxing out their 401k and their IRA contributions, and you still have extra money. So I'm gonna stop and see, are there any questions?
Yes,
There is
Anita.
one.
Okay.
How did you learn about this backdoor? I just recently had heard about it, and this would have been great had I known this while working.
Well, Ken, that's a great question. So as you get towards retirement, or when you really want to retire, you're thinking that, hey, I need to start, moving some money. So I got past the normal advisor at Fidelity, and I wanted a higher level advisor. And that's who told me about this. She told me about it, and she also helped me go through scenarios on how it would work. Because a lot of times, you're thinking, well, where am I going to get the money? But she helped me go through some scenarios on where to find the money to do the stuff. Whether it, my side hustle, I lived off that income and just banked that paycheck money. Because it's so important to maximize your W-2 money, because there's benefits you have versus getting other paycheck money. Not paycheck money, but other monies. But yeah, it was a advisor from Fidelity.
That's great. And I was with a company where I got, he did one thing. He talked me into doing a in-service transfer prior to retiring. And that actually helped me get started in my alternative investments. But the problem is with him and with most of these advisors is they're going to sell you just their product. They're not going to tell you what's best for your situation.
That is so true. I can't agree with you more.
Yeah, no, I love this presentation. This is excellent.
Well, thank you. Other
And
questions?
We do have some from the chat. John Doe actually said, I usually claim that even though I probably shouldn't. Are you saying or suspecting you are doing something you feel could be illegal?
John, can you come off mute and ask that again? Okay, I don't understand the question. Can we go on to the next one?
No worries. For gifts to charity via Fidelity,
I think
is
her
that stock only?
question was if we were doing anything illegal. As far as I know, it's not. If you convert your IRA to Roth IRA every year, it's not illegal.
Oh, yeah, correct. Okay,
You can't convert the whole thing, but yes, you can convert the allocated amount from the.
okay.
Anita, right along with this point, if I might mention something,
Sure.
is your tax advisor, your tax people, a lot of them won't tell you this kind of information either.
Agree.
And that's the shame of it. You would think that they would help you.
Yeah, you would think. Okay, any other questions on me?
Yeah, for gifts to charity via Fidelity, is that stock only?
So to fund the account, I use stock, but you can use other things to fund it. You can use appreciating assets as long as you can, they can quantify them. So as long as, once the money goes into that account, depending on how you fund it, then money and dollars has to come out the account and go to a 501c3. Okay, anything else?
So all you have to do to get this mega backdoor Roth account is just call Fidelity and ask them to open an account where you can just contribute before taxes. Is that all? Or
You said all you have to do is call them and open one?
yeah, is that what it is?
Okay, so what you would do is you have to open up a savings account.
Uh-huh.
And then once you have your after-tax money from your W-2, kind of like you have multiple accounts with Fidelity. I'm just using Fidelity as an example.
Mm-hmm.
You move in the money from your savings account, and then you basically specify, hey, convert it to a Roth. convert it to a Roth, and then that's pretty much all I had to do. I was pretty surprised.
So it's still after tax, right?
It's after tax money.
But it's growth without tax. That's the thing. Okay.
Yeah, it's not before tax. The great thing is it just allows you to put even more into a Roth.
Yes. Thank you.
Okay. So any other questions, or should I move on?
Move on.
Okay. So the Fidelity giving account. So just to go into details there, because I think somebody did ask that one. So this one is you basically contribute to it's another account that you can open up. Fidelity has one, other places have one, but this is just my experience because I use Fidelity. So you open up the account, and you're basically immediately eligible for an immediate tax deduction. You make your contribution. So for me, and I'm not going to go through this in detail, but I think it was in 2021, where Tesla was running around $900 a share. I was like panicking because I'm thinking I want to sell some Tesla, but I don't want the tax consequence. So I donated the 10 shares of Tesla stock into the account. And I immediately got that $9,000 write-off. And while it was in the account, I put it into different, funds so it could appreciate. And then I set up, so I'll just use my church, for instance. I'll give $150 every month just for a church, just because I want that to be on a rolling average. So it does it automatically. And I look at the account and it doesn't move that much because the account's appreciating, and I'm giving this, $150 to a church. And at the end of the year, I still get my church, write-off, but I also got the write-off for moving the stock in there. So, and that's really a gray area, because if they're still giving me that write-off, I'm still going to claim it.
So Anita, can I ask a question?
Sure.
So when you do the write-off though, do you have to spend like all the money you donated there, or you can, or you spend whatever, you don't have to spend the whole thing?
You don't have to spend the whole thing when you're doing your grants.
Okay.
So like initially, if I had 10 shares at $900, that's $9,000, and say $9,000 in the account. Every month I write a check, or they write a check, because this is on autopilot. They write the check for $150, goes to the church. It's invisible to me. So whatever money that $9,000 made, appreciated to, you have that minus the grant, distributions that you've been given.
Mhm.
So sometimes I look at this account and it doesn't really move that much.
Right. So basically your account stays whole, but you get their full write-off right away.
Yeah.
Oh, I see. Got it.
Yeah. So it's kind of cool, right?
Yeah, that's cool.
Versus like having to write a check out your checking account or something like that. So yeah, this is probably one of the best ways to do it. That's why when you think about like athletes, they have all these charitable contribution things. This is one of some of the strategies that they use. And it's I highlighted donor advised fund, because you're the one deciding where it needs to go, which 501c3 it goes to. So it's really cool. If you're already giving money to your school, to, I don't know, some pet care place, something, it just works out well. Okay.
So someone asked, what does immediate tax deduction mean? They donate stock to their church, not through Fidelity, but get a donation credit without taxes at the next cycle of tax returns.
Repeat that again.
What does immediate tax deduction mean? They donate to their church, not through Fidelity, but get a donation credit at the next tax cycle.
So the immediate means if you instead of donating straight to your church, you're putting it into your giving fund. And so your giving fund, Fidelity is going to send you a something that you can write off because you gave them some money. So that's where your tax deductibility comes in. And then every month when you make your grants, and this is where the gray area comes in, you probably shouldn't claim it every month when it goes out, but I still do because I still can say, hey, this is, if I get audited by the IRS, which I kind of know very well, I have the receipts. So it's not what you do, it's what you can prove. And this, I've been doing this for like maybe 2-3 years. So you give it to the Fidelity, they give you your deductibility, your receipt. And then over the years, you decide, hey, I'm gonna give to these 3 charities.
Anita, can I follow up on a clarification there? So your Tesla example, 10 shares, 9,000. So you put 9,000 into this donor advised fund with Fidelity. They're immediately, I'm still not clear what immediately means, but they're immediately giving you a tax value for that 9,000 that you're putting in. You can't claim it, pull it back, right? You're committing the 9,000 into an eventual set of charities. When you actually allocate to them is your choice, and then you're taking a secondary deduction on $150 a month.
Yes. That's where the gray area. I told y'all it was gray.
That's pretty gray. Yeah.
Yes, that is the case.
Okay, thanks.
Right. And honestly, at the end of the year,
Anita, you're breaking up.
put it in my records. So I warn y'all, this is gray sometimes. But yeah.
Anita, we can't understand you, unfortunately.
Are you breaking up or is it me?
Yeah,
I think
Can you guys still
he
hear me?
asked if it was her or
we
us.
can
I
hear
think
you
it's
better
you.
now.
Oops. Now we can't hear it all.
Oh no, I was learning so much. I hope she comes back.
She probably logged off to log back in. We'll give her a few. We're not going to get through the presentation with all these questions.
Sorry about that, you guys. You guys can still hear me, right?
Yes.
Yes, we can hear you much
sorry.
better.
I have a internet connection that really is not wanting to cooperate with me today. Let me go back and reshare. All right. All right, can you guys see my screen again?
Yes, we can.
Okay, so any more about the Fidelity stuff?
We do have a couple of questions in the chat.
Okay.
Also, you can only deduct if you itemize your tax savings.
Yes.
Or is it okay? Or is it a tax credit that you can write off?
No, you have to itemize.
Okay. Does the charity contribution still lower one's AGI?
Does it? Yeah. When you have deductions, it reduces it. And that, I mean, this goes along with all the other deductions that you claim. I'm sure you're probably claiming your primary residence tax, your interest, stuff like that. So it goes all into that bucket, maybe your car tags, all that kind of stuff that you normally write off. Because as you know, over the years, your deductions have been limited. So this is just one more to add to that. Okay.
Someone asked, is the $9K you put in the giving account invested?
Yes. You get to choose what you want it invested in. They'll go on. Okay, I can't say you have a huge, range of things. Usually it's certain mutual funds that they'll invest in, things that are pretty safe, but do give a good return. You can't put it into the fund and then turn around and invest it into stocks. I don't think they let you do that. They give you a preference on what you want to invest in. So it is some pretty decent stock mutual funds. Okay.
Anita, but all that money in that fund has to be taken to charity, right? You cannot take it back to your pocket, correct?
You cannot reclaim the money.
Correct. Okay, makes sense. Thank you.
Can keep that account open as long as you want.
Okay.
Can we get to Anita's content and then ask questions later on when she's done with her content?
Yes. Okay, so let me go ahead and go forward. I have two more to hit. 1031 exchanges. So I think we all know about 1031 exchanges. Basically, this defers capital gain tax when you sell or buy like properties for business or investment purposes. Properties, when we say like, this would be like a multifamily for a strip mall or a single family for a single family. So, you all got to stay in those classes of properties. The proceeds from the sale of the original property, it has to be held with a qualified intermediate who facilitates the transfer. So you can't take possession of that money. You get that disqualifies you. There's a lot of rules to this. And then also you got to identify a replacement property within 45 days of closing the original property and complete the purchase 180 days or by your tax return due date, whichever is earlier. So I have done this before. The pros are you can defer your taxes on that are owed on the sale. 1031s are repeatable on the same house that you keep selling and selling and selling, or on different houses that you buy and sell. You get to reset your depreciation. So if you had a property and you've owned it for 27 and a half years, you don't have any more depreciation. And then the other pro, and this is the one that sometimes you don't find out about, but after time, IRS loses track of that whole exchange. And this is what I've learned because I had a property, I had it for like 10 years and then I sold it. And then, I deferred it. And then I sold it, 10 years after that. Let me make sure I clarify this. I had a property 10 years later, I sold it. And the property was already a 1031 exchange. But after the 10 years that I sold it, I pretty much, had to step up in cost basis. And they never had any record of what that old transaction was that I did in 2008.
So wait, just to
somebody asking a
understand.
question, or are you on mute? Okay. And then I put down the 26-month and 6-year because 26 months is the IRS's, usually that's what they look, it's usually 3 years that they go back and audit you. And then 6 years is if you're in the process of that being audited, you have like 6 years to close out or some kind of record. I got to go back and look at that, but that's what I think I remember. So you figure after 10 years, they're not going to go back and say, hey, you have all this capital gain, because it's hard enough for me to figure that out. And I know it's hard for the IRS to figure out. So they start losing track after a period of time. Okay, the cons. There's a lot of rules. It's time consuming. It requires multiple procedures, rules, regulations. This causes delays. So if you don't meet that 45-day and the 180-day timeline, then you lose it. There's strict time constraints. That's kind of a key note to remember. And also, if you don't do the exact amount and you have overage, you might end up paying taxes on your extra, which is called a boot. So my tip on this one, find your replacement property first and then sell the original property. Okay, any quick questions?
Yeah, Anita?
Yeah.
Have you, so I know some of the syndicated real estate GPs will offer a 1031 into a syndicated offering.
Yeah.
Have you ever done that?
Yes. So in that situation, I sold a property and I got the proceeds from it. Well, actually, no, let me go back. I sold the property and I did just pay the normal taxes and I moved the money into the syndication. So no, I didn't do it with the syndication because it was too complicated. So I take it back. No, I did not do that with the syndicator because I thought it would have been a little bit hard. In retrospect, I probably could have, because if I'm selling a multi-unit and there is a syndication to invest in a multi-unit, then it probably would have been easy. But at the time, I think I was going from like a single family to invest in storage units. So that wouldn't have worked.
Gotcha. And the other thing I was going to ask, but it's irrelevant, is have you ever 1031'd into multiple syndications? Because my concern with 1031'ing into a single syndication would be it's a large sum. And then you're pretty substantially invested, and depending on the quality of the property, you may or may not want that many eggs in a given basket.
Yeah. Hey, JM, are you asking a question or are you just not on mute?
JM just not on mute.
Okay. Okay, I don't know why I can't mute people, but okay. Thanks,
Amy,
Don, for that.
Amy can do it.
Thanks.
Any other questions? Okay. If not, the other thing I'll also remind you guys is that the thing about the 1031s is there's these time constraints. It leads to desperation. So sometimes realtors love people who do 1031s because after they sold their property and they are helping them to buy another property, they have a beautiful target. They have just a sitting duck. And they can just basically call somebody and say, hey, we got a live one. We got a selling one. He has a time constraint. We got, so sometimes it gives away your negotiation power. So that's why that's what my tip is for. Okay. So the most complicated one, and this is the one I think Daniel and I talk about a lot, is using a Roth conversion via a syndication. So for this one, we basically, it's a little bit involved. So the real estate syndication brings, if you guys don't know what it is, it brings together a bunch of people, and these people have to be accredited in order to purchase some kind of large scale deal, something that you probably can't do on your own. So it's kind of like crowdsourcing. So examples of syndication deals could be like a larger apartment complex, a 20-plex or something. Could be trailer parks. It could be storage facilities, hotels, office buildings. One that some of you guys might know, there was money raised to build the West End downtown Tempe. So I was able to get into that one. That one was pretty cool. In fact, this is the one I actually did this on for one of the ones. So the process that was used was, and I'm kind of being generic, but you got to find somebody who's willing to do this Roth conversion within the syndication. So you got to vet your real estate syndication operator for this opportunity. So you want to make sure that they have the Roth conversion opportunities. So once you find that person, you're going to invest your pre-tax savings monies, money that you have not paid taxes on, and you're going to use a custodian. So like a self-directed IRA custodian, like an equity trust. Okay. So I basically, when I find my syndicator, I know I want to invest in that deal. I go through equity trust, give them their money because they have to hold your money. And a lot of times that money is coming from Fidelity being transferred over to equity trust. So once the money is with your custodian, then you can do the deal. So now equity trust invests in the syndication on your behalf. So now you're in the deal, everything's good. They're promising you whatever, 15%, 20%. So what they do, so for like the Tempe example, they had to do an evaluation study. And right now it's just land. So when they do the evaluation study, it's going to come back to 50, 60% of the full build out estimate, or the full build out amount. So then they're going to basically say, hey, if you invested $100,000, your investment at this point is looking like 55,000. Okay. Then you convert. You basically say, hey, Equity Trust, I want to convert that amount that I have into a Roth. So convert it from pre-tax to a Roth. And you pay the taxes during that tax year of conversion. So you pay taxes on $55,000. And then you ride out your syndication agreement timeframe. Usually they're about anywhere from 3 to 5 years. And at the end of your syndication agreement, your full amount that you invested, so in this case, it would have been 100,000. That is what is used to evaluate what you get at the end of the cycle. So if you're getting, it's 3 years, you've invested $100,000, you'll get back your $145,000 after the 3 years. The pros are there's many ways and asset classes to passively invest. So it gives you a lot of opportunities. The cons is that syndications in themselves have risks and investments are illiquid. So that 3-year time frame is important because you can't pull your money out as soon as you did your conversion because it just doesn't work that way. You've already committed to doing that. So it's kind of what it shows on paper. Because a lot of people are like, oh, like $100,000 went down to 55,000. No, that's what it shows on paper. And that's what you need to do for the IRS. If you ever got audited for that, you basically have your conversion evaluation your evaluation study to prove that, hey, you invested this is how much it's worth now. So this one, I know there's a lot of questions, so go ahead.
I have a question.
Sure.
So could I use this process to buy like a single family investment property? Like I have a rollover IRA in Fidelity from a previous company, or if I quit Intel and I converted that to a rollover, and then I call up this equity trust and I say, can you create a self-directed IRA of some kind and put that money in there? And
so
then
do you have your opportunity already? Do you have a sponsor who has the Roth conversion opportunity?
What do you mean a sponsor? Like another person to partner with,
So all syndications, they have sponsors, right? They're the ones who go through the
Well,
due diligence.
she said purchase a single family property.
Well,
so
I meant purchase a single family property, but partner with someone who has an LLC. So I guess they would be my sponsor.
No,
because
so that would not be a sponsor. Sponsor somebody who had to do the due diligence, and there's a lot of like private placement memorandas and legal documents that they have to prepare in order to be a vetted sponsor. At least in my example, you need to vet a sponsor who's been doing this, who has a track record of doing this, because you can't just pick anybody, because otherwise you open yourself to risk. So make sure you vet the sponsor. So no, you.
How do you find a sponsor? Yeah, how do you find a sponsor, I guess?
How do you find a syndication
for real estate investing? Yeah.
So for me, I belong to a brokerage group, not a brokerage group. Well, I guess an investment group, another one. And it's like a Shark Tank where they pitch different opportunities. So that's how I found mine.
Okay. Is that local here in Oregon, or?
I'm in the Bay Area.
Oh, in the Bay Area. So just find like a local investment.
For this situation, just hit me offline.
Okay.
And then we can talk.
Okay.
So just take my emails. My email is, and I'm sorry I didn't put it in the thing, but
if you could put it
in G@outlook.com. So just contact me offline.
Okay, that's easy. Thank you.
Okay, any other questions?
Nope, I'll let others ask. I have probably too many to ask. So.
Okay, Ami, we're good?
Yeah, you're good. Oh, well, no, I have one question. On your example, the 145K return, does it go back to your Roth account?
Say they get, oh, yeah. It stays within your account with Equity Trust, which is a Roth account now. Before it was a kind of like an IRA, right? But now it's more about Roth IRA. So yeah, you can't take possession of any of the money unless, of course, you're like, you got to follow the normal IRA rules. Some rules are if you're 55 and a half, you can probably take the money out. If you're not, maybe you might have to pay taxes. But yeah, there's a lot of rules which I can go into, but for the sake of this presentation, I don't necessarily want to. Okay, any other questions on the Roth conversion via a syndication? This one's pretty heavy. This one took a lot for me to figure out because it didn't sound real, but I have actually done it. I've done it a couple of times. And I realized that I had a lot of money that was pre-taxed. And I just, at this point, I'm not working. So I want to kind of start moving it to the after tax because I don't want to get hit with required minimum distribution payments and all this other stuff. And when you start taking money out, it throws you into a different tax bracket. So that's a whole nother, bag of worms to deal with.
Well, you won't get that till you're 72, almost 72, Anita.
I'm planning ahead.
Good for you. Seriously, good for you.
Yeah. I mean, and for those of you guys who are way from that number, let's even start with like 65 and you start doing Medicare, and your Medicare premiums that you thought weren't going to be expensive are a lot more money when you have more money coming in. It's called IRMA, starting with the I. It just gets crazy, and it's been a surprise for me, learning all the stuff that, even when you think taking money for your Social Security, whether it's going to be taxed or not taxed, you're gonna pay money when you have to be in a different tax bracket. Whereas if I'm in a Roth, I can choose how much I want my income to be. I'll take a little from the tax bucket. I'll take a little bit from the Roth bucket. So I can control how much every year I need to have coming in. Okay.
Hey, Anita, on the operators who offer Roth conversion as part, do you find a decent amount of those opportunities? A lot of the ones I see don't.
No, I don't.
Okay.
They're harder to find.
Yeah.
Yeah. And I think last time I came in, I talked about the share group. Those are the people that, will bring some of these investments in. And I'd probably say 1 out of every maybe 10 that they bring in to present have the Roth conversion opportunity. So no, I don't see a lot of them.
Okay, thanks.
That's why I kind of put this one last, because it's not, it's good to have education. So when you want to do it, you kind of know a little bit about it. But until you actually go through it, it's like, oh, okay, now I get it. Because it took a while before, of him convincing me before I actually did it, because I didn't understand it. And if I don't understand it, I just don't do it. Okay, I'm gonna go on to my
Anita,
Yeah.
one more question on using IRAs and
Sure.
Roth for real estate. One of the reasons I like investing in real estate is for the tax advantages, right? There is depreciation, there are costs that you can deduct from the revenue that you're getting out of it and whatnot that helps, minimize paying taxes on that. Now, if you're making those investments through these IRAs or Roth IRAs, we won't be able to use that information similarly, right? We would be losing some of those tax advantages that would be getting out of it.
Well, when you're investing through a syndication, it just depends on what they're going to allow you to write off. So syndications are like a whole nother animal. So it's probably good to have a little bit of both, something that you actually hold in your name versus something that you hold in the sponsor's name that you're going to be getting a K1 from. The tax document is a K1. So yeah, there are pros and there's cons.
Okay, so what you're saying is, in your experience, syndications are not necessarily passing down those write-offs and depreciations and whatnot to the limited partners in there.
So it really depends on the syndication.
Okay.
And how they're
if it's in a
structured.
tax savings account already, it probably doesn't make sense because you're not, stuff you have in your retirement accounts, you don't really use that to write off stuff. Because
exactly. Yeah.
you only
If
do
it's
it when you take the money out.
Sure. Yeah, that was my point. If you do it from an IRA and you're getting pass downs for depreciations and whatnot and so on, it's really not, you can't take advantage of those things if you do it from an IRA. So for me, that's a con for doing, real estate from IRAs.
Yeah. Okay, so last slide. This is my closing thoughts. So I was trying to figure out what do I want to say if I had to say something. So the first thing is, if y'all been attending, you have, I can't believe I took out that other half. If you've been attending these real estate sessions and not taking any action, you're wasting your time. And there's really no reason not to go for it, because I look back on, like, you have a very supportive group of folks here, and you have people to ask questions of. And I remember getting started, I didn't have anybody, and it was tough, and I was, and I needed that. So take advantage of this group, because this is an amazing group. And a lot of times, it's not, people don't do it because they have this fear of failure, but sometimes I think it could be a fear of success, where it's self-sabotaging, and you basically say, oh, I'll get to it next month or next year, and they just procrastinate. Because I was always asking people, hey, you should buy a single family house. This is when I used to live in Arizona, and places were like $100,000. And they're like, okay, yeah, I'm gonna do it, but I gotta go do this first. Or they had other excuses. And I was just like, no, Phoenix is amazing. It's gonna grow one day. I was just trying to buy up as much as I could. And then the other thought that I had was, sometimes the reason why most, if you do invest in real estate, you definitely have to set your goal. And it's not that you really messed up. It's just that maybe the goal wasn't set correctly. Maybe it was too lofty. So the method that I've always used is called my XYZ approach. So I always say, I want to X by Y because Z. So X is your what, Y is your when, Z is your why. What, when, why. Okay. So an example would be, I want to own a single family home by May of 2025 to help me become financially free. And then you get more specific and you drill down. And I think it's really important to make sure that if this is a goal, only real estate is a goal, then you should say no to everything else. You got to make sure that you set your goal. You take time every week, almost every day, to kind of check into how you're doing, your progress. We're good at having indicators, your indicators towards achieving it. And also, if you haven't written down what you want to do, then that's half the battle, because you gotta have some kind of accountability. And this is a great forum to help you achieve that. If you don't have, this forum, maybe you have other accountability partners. If you can't find an accountability partner, maybe join other things within your city, meetups. If you don't have a meetup within your city that really helps focus on this kind of stuff, start your own meetup. People will come. But it's just been an amazing journey, this whole thing. And I'm really happy to be here and that you guys are even listening to me. So I will end there.
Thank you, Anita.
Thank you. That's so helpful.
All right. Any last minute questions before we end?
Someone asked, where are you buying now?
Where am I buying now?
Mm-hmm.
I am mostly doing syndications. And I'm gonna explain it so it makes sense. So there's like certain single project syndications, and then there's multi-project syndications, and then there's syndication funds. So right now I'm looking at a syndication that is healthcare, where people are like looking at some of the old practices that exist and going in there to improve these practices. And usually they'll go in and they'll have like maybe 4 different buildings or 4 different offices that they'll come together as a conglomerate to help improve, and then they'll sell it. They'll buy them, improve them, and then sell them. Because if you're a doctor or something like that and you have your own practice, a lot of times when you get to be like 50, 55, you don't want to do that no more. You want to sell your practice, but you've been doing things the old way. So the syndication that I'm in now, it's been pretty good because we've been able to modernize these practices and then sell them. So that's what I'm working on now.
If somebody wants to know, can you drop your contact info?
I sure can. Let me drop my email in the chat. All right, let's see here. Who can see it? Let me put everyone. Everyone. And I have no problems talking to people one-on-one because that's usually the best time to chat if you had questions. Because it's kind of hard because all situations don't apply to everybody. So, all right, can you see it okay?
Yes.
All right.
Thank you so much, Anita. Can everybody come off mute and thank our guest host?
Yeah.
Thanks, Anita.
Thanks.
Thank you, Anita.
Excellent presentation.
Thank you.
Thank you.
Thank you.
Thank you.
Thanks, Anita.
Thank you
You guys
so
have
much.
a good 4th of July weekend.
You too.
You too. Thank you.
Right.